Hi, in this video, we're going to talk about the semi-strong form market efficiency. So this level of efficiency states that from public information, we cannot make consistent alpha or consistent abnormal return or consistently beat the market. So what is public information here? So first, you cannot get consistent alpha just by looking at public information. So these are not just prices, but also the fundamentals of the firms. So namely, those information that you can find from a company's financial statements, the newsletters. Okay, so these are all public information. So it assumes, or it states, that if the prices can reflect all public information, then no consistent alpha could be made. So the fundamental analysis in this case is useless in the pursuit for consistent alpha. So that's going to be the fundamental analysis. So it does not give you any consistent alpha here. So what is fundamental analysis? So compared to technical analysis, which only looks at the prices or the past prices of stocks, fundamental analysis takes a look at the the basic operations or the basic information for this company, for this specific company, especially the financial statements there. So the three statements, namely the balance sheets and the income statement and cash flow statements. So we need to know the fundamentals of this firm to make predictions or make judgments about its prices or its value. So this time we're looking at individual firms, but for technical analysis, well, they're just a bunch of numbers. They're just a bunch of prices. Here, we're differentiating the companies. So for different companies, I would have different judgments here because they're in different markets or they're operated differently. So it requires in-depth knowledge for this specific market or for a specific firm to carry out accurate fundamental analysis. But if all public information is available and they can accurately and instantly be reflected in the prices, then carrying out fundamental analysis shouldn't yield any consistent alpha here. Okay, but then is this always the case for any market? No, not necessarily. For some markets, to some extent, you can argue that semi-strong form is achieved because maybe the banks or large institutions with very expensive human resources and computational power and financial expertise, they can carry out fundamental analysis on a very, very detailed and fast pace. But still, if they cannot make consistent alpha, then maybe you could say there's a bit of semi-strong form in this market to some extent. Okay, but then there are always a bit of anomalies in the market that challenge the semi-strong form. One of which is called the post-earnings announcement drift. Okay, so it's post-earnings announcement drift. Let me write it here. Post-earnings announcement drift. Okay, so if you take a look at the news or financial websites, you would always be bombarded, if not so, with with earnings announcements, because that will be the most direct indicator of the performance for a specific firm that you should keep a watch on. Okay, so with earnings announcement, you can get the first-hand information about the performance for any stocks that you're tracking here. So if an announcement is made, which means there's more public information, then the price should instantly, or at least very quickly, adapt that information. So, for example, if a company is doing very, very well, okay, so after the earnings announcement has been made, so it's a very positive result. So we can expect the price to be higher than before. Okay, so before the announcement was made, we can assume that the price is going to fluctuate at some point, right? So the return there is going to stay same. Okay, it's going to stay the same here, right, at the same level, at least in our benchmark level, right? But after the earnings, if it's a positive earning, then we have more information on this company, and it's good information, and it's going to give us very good direction here, which says this company is doing very well. So if the semi-strong form of the market efficiency holds, then the price should reflect that instantly. So we could have the market return before the announcement here. Let's say t equals 0, right? So this is where the announcement is. This is when the announcement is made. So before that, we have some sort of fluctuations on the returns, which is absolutely normal. That's because of the random noises there, right? But after the announcement, we should see the return bumps up by quite a bit and then stays there for the rest of the time, unless there's another news or another different public information there. So just for the sake of this specific and hypothetical good news here, the price should go up and the returns consequently would shoot up and then keep at the same level for a long period of time. So this is when we say the semi-strong form market efficiency would work. But what about the post-earnings announcement drift? Okay, so sometimes these earnings announcement would come as a surprise. So there will be predictions from analysts from different investment banks, financial institutions, that they will give out estimations or predictions for a company's earnings. But sometimes they will come up as a great surprise in both ways. So for example, if it's a very good way, it outperformed let's say the majority of the predictions or the analysis analysts' predictions, then we would have a great surprise in a positive way. And this could induce a bit of over optimism. So what would happen here is that people continue to buy it and shoots up the price that is even higher in this case. All right, so if the market is in semi-strong form, the return should stay here. But the reality is that it keeps going up. Okay, might not be in the very perfect straight line way. Okay, so let's do it in another way here. It might be like this, and it continues for weeks or sometimes even months. Okay, and then maybe after some time, weeks or months, people start to realize, oh, that is an over optimism. Yeah, we're overly optimistic about that stock because of the earnings surprise, and then it cools off, and then gradually it goes to the level of return that it's supposed to be, right? So that's going to be the post-earnings announcement drift if it's a good surprise. But in the other way, it could be a very bad surprise that the company actually underperformed compared to all the predictions made by the analysts here. So if it's a bad news here, right? What if it's a bad news? If it's a bad news, then we could have something like this, okay? If the market works, and then it should stay there. The return goes negative for some time and stays around that level, okay? But if we have over pessimism, that everyone is so devastated and disappointed in that we could have sold more than we should have, or at least compared to what the models would say here, or the efficiency hypothesis would say here. So the actual return would drop even lower for quite some time, and then after people realizing, oh, this is not supposed to happen, okay, this is not something that's supposed to happen, we're seriously undervaluating the stock because of the over pessimism, and then people start buying it and the price goes back to normal. So that's the post-earnings announcement drift in another direction. So the existence of the post-earnings announcement drift is going to impose challenges for the semi-strong form market efficiency. If we can find such instances or examples in the real life or in the real financial markets, then we can say in this market, at least for this period, the semi-strong form market efficiency is violated. Okay, and of course this is not the only example or the instance that can violate the semi-strong form market efficiency, but it is good to know that what semi-strong form means, and at least one of these challenges, one of these anomalies that could challenge this market efficiency, which is the post-earnings announcement drift. Okay, and this touches the border of behavioral finance, which we will not go too much into detail about that. Right? Okay, so this is the semi-strong form market efficiency, and there's only one more, which is the strong form market efficiency, and we'll talk about it in the next video. I'll see you there.